just a brief overview, a little bit of what's driving the overall market situation. And what I think is one of the things when you look at Europe is that after we had these conversions up to the euro introduction, then we have these kind of artificial stability during the first years of the euro. Then Lehman came with all the turbulence. Looking now at Europe again, it's a little bit of time of converging again of the government bond yields as we've shown it up here. So that's also a little bit of what's going on in the residential markets. We see that the more and more markets are back for investors as investable markets. After the financial crisis, it was more or less only the core markets. Today, investors are not afraid to go to Spain, to Ireland again, because they simply see it as a worthwhile addition to their portfolios. So what is now special about the residential markets when you look at Europe? Overall, looking at residential yields comparable to bond yields, there's more or less in all markets you look at, it's quite an attractive spread of prime, or let's say decent real estate, rented real estate, residential real estate above government bond yields. And you can still argue to a large extent how large has the risk premium actually to be for residential compared to government bonds. Is a residential portfolio that much riskier than a government bond in some countries? Is it riskier to invest in rental apartments in Dublin than to invest in an Irish government bond? That's some of the discussions we increasingly have. There might be different liquidity, but the risk profile might not be that much of a difference. And I think that's increasingly what the investors realize. Additionally, when you look at the overall residential market, and the rental market is part of the overall residential market, one fact that now favors rented residential to, let's say, the past years, especially up to the financial crisis, is up to 2007, 2008, let's say start financial crisis, we had a trend of increasing ownership rates across Europe. Since the financial crisis, ownership rates in a lot of countries have seemed to turn the corner. Ownership rates are going down, governmental support for ownership is decreasing. The Dutch market is one example, but also if you look at Spain, if you look at other countries, there is a lot of activity now politically that favors rented, and that also gives investors for the first time the opportunity possibly to really gain access to markets that have been very local in the past. For example, Spain is one of the markets with ownership rates north of 80%. It was no market in rental investors would have looked at in the past. But with the activities currently underway in Spain, increasingly investors also in the rented residential sector look at Spain as one possible market to invest in the near future. But when you look at these rental markets across Europe, what you have to keep in mind is you have still a very diverse regulatory pattern in Europe. What we've plotted here is a little bit on the x-axis. You have an index of rent control compiled by the OECD about 2 years ago, and on the y-axis you have an index of tenant-landlord relationships and how hard they are regulated in the OECD countries, also plotted also calculated by the OECD. And what you see is that trend-wise, the two regulations seem to have a positive relationship with each other. And on the right-hand side, on the right-hand upper corner, you find Sweden as one of the heavily regulated markets in Europe. Nevertheless, it is an established rental investment market if you look at Sweden. At the same time, what is interesting, the government policies currently favor, let's say, a little bit of a winding down of regulations to make Sweden a little less regulated. And the interesting thing is, on the other hand, you have to understand the regulation, and then you're happy, or you can, as an investor, very good act in these markets. The only thing is regulations have to be stable. Or if you have a decrease in regulation, that's quite easy to deal with. Germany is currently going a little bit the opposite way. We're trying to increase the regulation, especially on the rent control side. The question will be if this really generates housing. That's something we will see in the medium to long term. But being an economist by education, I would say regulation in itself has never created any single housing unit. So the question is, why should it happen this time? when dealing with the European residential markets, one of the difficult things is to really understand what drives these markets. Trying to compile rent series for the different European countries. And you run into big trouble to really get down to hard, let's say, rent-based data. You have these rent indices based on consumer price indices, but that is something of the household budget calculation. It's not based on really asking rents or contracted rents in the markets. So the hard thing for any investor in these markets is to get by with with really data. And if you have the data, what's presented up here, you see rent control is really working in the direction it should be. Higher regulated markets have less rental growth than less regulated markets, exactly what the regulation should act for. But what makes it quite interesting for investors is volatility seems to be a little higher in higher regulated markets. And volatility is something an investor likes because it offers opportunities, as long as you understand how the market is functioning. And that is also what you see in transaction activity. Regulation itself is not holding back transaction activity, because regulation also means you have a decent rental market. It doesn't make sense to regulate a market that is not existent. Therefore, if regulation is in place, there is a rental market. Therefore, there is a market that can be of possible interest for investors. And that is also something you have seen in the past, and going forward, the interesting point will be how will markets like the Netherlands, how will markets like Spain and Ireland favor in the future with now the activities in place in these markets. So I think that is one of the points we see when going forward. Regulation in itself will not be a hindrance. The problem with the regulation is only if it's not stable, if it's changing every once in a while, and if regulation is not quite clear. Something that can be really argued for the German one, because if you read the current law, it's not quite clear what is the ortsübliche Vergleichsmiete, the regional equivalent rent, because simply there's no set out procedure how this is calculated. Overall, I think currently we have, for the first time, a situation in Europe where you really can truly execute a pan-European residential strategy in the rental sector. The only question for me is, are there enough brave investors out there who really want to do that?